All right, so welcome to another video. Today, what we're going to do is we're going to go ahead and take a look at buying the dip with a bullish diagonal strategy on Roku with some options. So we're going to go ahead and take a look at that. Definitely keep in mind that none of these are recommendations to buy, sell, or trade anything. It's just my own personal opinion. If you want to grab my opinion, check out our Discord channel. You can go into our Discord right there, and then you can see some of the charts that I post. And also check out the website right there. There's a lot of great stuff there on the website, from freebies to live classes and much more. All right, let's get started with a diagonal on Roku. So why might I do a diagonal on Roku? There might be a couple of different reasons. You might be bullish on Roku. You might say, hey, we're probably going to pop sometime soon. The other thing is that if I'm looking at Roku, it's kind of coming into that $100 sweet spot right now. And I'm thinking, well, what if it breaks above that 100 and it can start popping and moving to that upside? And that's kind of why you might be looking at doing a maybe diagonal here on a stock like this, because it's been just going down for quite a while. If you just kind of look at this chart, the stock has been trending here to the downside quite a bit, and we're down, I think, about around 70% or so from those highs of about 490. So we're down in that $100 level. So what I'd like to do is kind of say, hey, let me take a cheap bullish bet on it. Not super cheap, but it's, the earnings are out, so I don't have to worry about earnings. And even though there's a lot of market selling pressure, like even today, if we look at just the SPY, continues to sell off. I'm just looking for a couple of day maybe bounce here in the future. So this might be a nice, interesting little setup here for Roku. The other thing is that what I like about Roku is it's got kind of like these dollar wide strikes. So it allows me to rotate a diagonal a little bit better. So you might be wondering, okay, why a diagonal? Why not a butterfly? Well, the volatility is high, but a diagonal gives me some flexibility for the rotation. That's number one. It also allows me to be a little positive vega oftentimes. And that way, if the stock does keep selling off, it gives me a little cushion on the downside. So, and what I could do is I could structure it with shorter duration, and then that way the volatility is less effective, but I actually do want that volatility. So if you want that volatility to be a little hedged or protected for the downside, it's okay then to go a little longer duration. It's like saying, hey, I don't know when it's going to kind of end, but if I'm looking for a little bit of pop, I want to lean a little bullish, but I want that extra volatility as a cushion. So it's a good way to kind of trade out that strategy or concept. So what do you do? How do you play something like this? Well, let's first start out with, let me show you a basic construction. So what I'm going to do is go into the 32-day options, and I'm going to sell one, okay? And then what I'll do is I'll go out and I'll buy one over here. Now, this is going to create actually a calendar because I've done the same strikes, but I'm going to show you how we turn it into a diagonal in a second. So the way that this works and why it really works is the one in the front month decays much faster than the one in the back month. Okay, so the front month, meaning the shorter duration, the 32 days will decay a lot faster than the 39 days. So the 32 day will expire, 39 day will be a little bit left. So the theta difference, or the time decay that you earn, will be much more advantageous or beneficial. And you can see here on this calendar spread, it's about $1.77 from a calendar. Now, with a calendar, the downside is if it pops, you got a little bit of a problem because now you're kind of stuck in this range. And if it goes up, you got a delta that's basically zero. So you don't get to make anything from delta. And this is where the diagonal might be nice, because now with a diagonal, if you get a little bit of a pop, okay, if you do a diagonal, you can just rotate one of these. Okay, so I'm going to show you here how to do that. We're going to go into this calendar area. I'm going to switch from calendar to custom. And then I'm going to take the June 10th, okay, and just do one little rotation with one strike. And that will give me a little bit of a bullishness to it, which means now I've got a positive 1.709 delta, and I still have my theta of about 2. Okay, so now if it goes up, I don't really have a lot of risk here to the upside, because now it starts moving to the upside. I'm okay. Even if it goes to 130, I'm still okay. And remember, with a little bit of theta there, as this slowly decays, even if it does go to the upside, you're still making 11 bucks. And I know it doesn't sound like a lot, or 24 bucks, but you have to look at the capital at risk. Okay, so you're risking about $140 here, 137, 138. So call it $140. So if you're making $14, that's 10% in 20 days, right? So here, if you can make, 15, 20 bucks, you're already at a 10% gain. So anyway, with these diagonals, they're a nice construction because now, why would you construct a diagonal like this? It's because if it now pulls back, you have a positive vega. The positive vega helps you when stock prices sell off because now options are worth more. And in that case, your diagonal actually starts opening up and expanding the profit range. So in other words, there's three ways here that you're making money, either the delta, the theta, or the vega. So these right here are your money makers, but they are also your risks. So if you make money from delta, right, if stock price goes up, you make a few bucks from the stock going up. So that's like $1.67 or so. So that's about a 1.67 shares that you kind of have in the stock. But with options, you can also make money from time. So you're making about $2 a day there. And then volatility, about $1. So if volatility goes down, you lose a little bit. If volatility goes up, you make a little from volatility. Now time just constant, and delta depends on the price. If it goes up, it's in your favor. If it goes down, you lose a bit. And now when you really start, putting a few more shares into here, you could have larger numbers here. And you could have something like a 10 delta, 11 theta, and a 6 vega. And now you've got some more room to the upside. Now, let's say you didn't like this rotation. It seemed a little too flat for you. Could you be more aggressive? Yeah, absolutely. The beauty behind this is with these single strikes that you have on Roku, what you could do is instead of a one rotation, you could do a 2-point strike rotation. And by doing that, you pick up more deltas. So now you're putting more emphasis on your price risk because you're rotating it more. So if the stock pops, you get more that way. The downside for that is you're using a little more capital. And if it goes against you from a pricing standpoint, you also lose more. So now you're making $18 for every dollar move up from the price standpoint, but you also can lose $18 for every dollar move down against you. So let's say this thing goes down about $1, you'll lose about, $18 or so. Plus you get some theta and vega and it mixed into that, and that gets the final formula of what you're making or losing. So anyways, this is a nice little strategy if you're like, hey, I want to buy a little bit of shares thinking it might pop. You could do something like this. If you're really cautious, you could also back it up a little bit. And I could go something like 93, 95, and now I've got more room on the downside. So how could you set up a stop, or when would you get out of something like this? Well, you could set a trigger of like a hard stop from a dollar figure. Or the other thing is to use a little bit beyond this break-even price right here. So you'll see there's a little red hash mark or tick here. Now this red hash mark is this break even at expiration. Now right now I'm looking at the break even today, that's on the white line, but the break even at expiration, there's a tick there. So that's about 86.56. And if you go ahead and kind of set it there, even a little past that, call it 85.45, you could set a stop there. So meaning either the trade's going to work out in your favor and you'll slowly go from 6 contracts to 5, 4, 3, 2, 1 as it continues to run up, or if it goes against you, you could be out of the full position if it kind of breaks this break even. So what's nice of doing this is controlling your risk based on the break even. So if you wanted more range, let's say, I could back this up a little bit more. And now I've got more range on my break even. Granted, the dollar figure I could lose about 321. Or I could go even further right there, and now I could lose 346 or so. Now you could also tighten this up for a 1-point rotation, and now you've got a little bit of a different dollar figure. So it just depends. Like there's nothing wrong with doing something like this. You might say, hey, well, but what about if it goes up? Yeah, you've got some room on the upside, not a ton. You got a little bit, but what if it slowly keeps grinding down? You've got much more room and range there on the downside. So you could really craft it in quite a bit. And if you want to have a tighter stop, and by using the break even, what you could do is do something like this, like bring it in tighter and say, hey, I want to have a tighter stop and I want to be a little more careful. And now you've got 92, 91 and a half as a kind of a stop. So by doing this, you've got much more room on the upside right there, but you got a kind of a tighter stop. So anyways, those are a few different ways to kind of play the trade and kind of work it. It just depends how aggressive you want to be. You know, and if you like to just kind of start in the middle, you could do that as well, kind of right near that middle, but some upside room. Just be careful with what you want to risk here on the trade. So define it, and you can use the break even right there as your stop and a way to kind of get out of the trade. So anyway, I hope that helps. Thank you so much for joining me. Truly appreciate it. And, you know, if you want to see some of the other great videos that I have, check them out over here. Get some freebies right down below. And, you know, I'll see you in the next video update. Thanks again, and I'll see you next time.